Welcome back to the Armchair Attorney podcast, answering the biggest questions facing everyone these days. Should I panic? I don't know. I'm just a simple country lawyer. I panic about just about everything. Sky is falling. That's what I live by. But before I get to my incredible guests of Ken Adamo, Chief of Analytics at DAT Dial-A-Truck, and our good friend, Professor Jason Miller, you know him. We love him. Go green. Go green. I got to say a shout out to the folks who helped make this thing possible. To my friends over at DAT Dial-A-Truck, on the pallid bust of Pallas, somewhere adjacent to my chamber door, sits the hat of DAT, who shall move freight forevermore. I just made that up. That was very catchy. Congratulations to all of you who are attending and listening. And our good friends at Genlogs, cameras everywhere, following us, watching us, telling us, where is my freight? Where is that trailer? Dude, where's my truck? That Genlogs knows. With their network of cameras all across the United States and the highway system, they are watching for trucks and trailers, trying to discover new insights around real freight intelligence, setting a new standard of care for finding fraud and fighting cargo theft. Oh, that's the introductions. That's the end of it. Let's get to our guests. First, I will bring in my colleague at Michigan State University, the incredible, and everyone knows him, Jason Miller. Jason, how are you, my friend?
I'm doing well, Matt. Thanks for having me on, man.
Are you excited for back to school? Are you living this dream, or is this a nightmare?
No, I mean, I am. It's good to see the energy when everybody comes back. Certainly gets a lot busier here in East Lansing, though, here about next week or so. But it's good to have the students back. I really don't teach in person anymore, certainly at the undergraduate level, so I don't quite get to live that. But it'll be good to have folks back. It's great for the local economy, if nothing else.
I love the local economy. And speaking of the local economy, since we two Michigan State friends, we now have to welcome our good friend, Mr. Ken Adamo, Chief of Analytics at DAT, and a Buckeye. Ken, how are you?
Pretty good. How about you?
I'm doing great. I'm wearing red because that is in favor of our friends over in the Buckeye State. How is the team looking? Is it looking good?
I think they might have a pretty good football. They might be able to fill the stadium this year. You know, they might televise a game or two as well. I've heard that they might actually be bringing this to cable.
That would be incredible. I have not seen them. Did they win games these days? Like, I don't remember how that goes at this point.
They won a couple last year. They won the last one of the year, which is always the most important.
Yeah, it's primacy and recency. That's the biases we have. So the first thing you see, you love. The last thing you see, you love. So that makes sense. That makes why people would like them. I don't follow sports very much.
Yeah.
Okay. So
they're pretty good.
So before we get to the questions that I have for you guys, there's a little bit there's some technical difficulties we're experiencing. So there have been this strange thing, tariffs. We haven't spoken, the three of us, since the tariffs from Liberation Day appeared, and now they're there. Last we heard, they were in front of the Federal Appellate Court. It had been overturned by the Court of International Trade. That injunction was lifted, and now we're waiting for the Federal Appellate Court to weigh in. After watching the actual oral arguments, I feel they're going to get overturned, at least at that level. But I think they're going to SCOTUS. I think there's no doubt in my mind. So let's forget about tariffs, because that's probably not going to be timely in a couple of weeks or months. This chart, Ken, you shared this chart not long ago. And for those of you who are listening to the podcast, I can describe a red line and a green line going in different directions. I highly encourage you to look at the chart. I'll put it up on someplace. But what are we seeing here? What is this thing? What are we learning about the freight market right now?
I mean, I would say it's stuck, right? I mean, this is a period where if I took this chart back another 10 years, that would bring you at least to the foothills of the great financial crisis before it. It's stuck. I think that's the best way to put it. We have not really seen a period, as you can see by this chart. This is meant to emulate the Coyote curve, by the way. So credit where credit's due. Chris Pickett at Coyote sort of popularized this view of year-over-year percent change, because sometimes it's very important to look at the actual nominal rate data, like what rates are actually doing, but it's not kind of sometimes a little bit difficult for executives or people who don't look at it every day to kind of gain a sense of what that means. So we look at it on a year-over-year percent, which we all can relate to percentages. And you can see contract very stuck, and then spot. We thought it was gaining some traction maybe around the time of the election, and then, as you mentioned, tariffs and other things have just completely kneecapped any sort of recovery.
Now, when we have a truck in the winter that doesn't start, typically the fuel has gelled. It needs to get something to get the motor going. We've had ideas of what could remove capacity, I think, and Professor Miller can chime in on this, like the English language proficiency. That was going to solve something. That was going to take out some capacity, reignite the supply chain. Do we see anything happening? Like, when can we be excited?
So English language proficiency turned out not to have nearly the impact that I think some folks predicted.
Wait a minute. So like angry white dudes with AI headshots on LinkedIn didn't accurately predict how many foreigners were driving trucks?
And folks like me who've, I've published more papers on trucking compliance than any other human being on the planet right now over the last 15 years. We don't know what we're talking about at all. But yeah, that didn't have an effect. And I mean, right now, I'm going to publicly say it. Basically, there's nothing exciting going to happen until as soon as Q2 2026. We can just write off the rest of this year.
In terms of like it'll stay the same, or do you think it gets worse?
So rates really can't go down much more. I mean, we are literally scraping along a bottom on these data. If you look at the producer price index for long distance truckload primary services, it's also scraping down along a bottom. So unless, barring some type of change in fuel, that would change absolute rates, but maybe not affect line haul rates that much, I don't see line haul rates really changing that much throughout the rest of the year. I mean, at most you're looking at 1-2% up, 1-2% down, but you're talking a bar that's essentially inconsequential at this point. You can see that in Ken's chart. It started to feel like around, I'm going to say December, January-ish, the market could be thinking about turning, and then nothing materialized this spring.
Man, so normally I don't take questions from the audience, but we actually have questions coming in. And since I have two of the best minds in freight, I definitely mean to exclude myself from that. I have a Logistics Lounge has a nice shout out. Thank you, Logistics Lounge. We love you. But Benjamin Kowalski, we'll see if I get that right.
He's a proud Yinzer. He's from the Freight 360 guys.
Oh, okay. I love Ben. Okay, good. Okay. I would love to hear Kowalski. Thank you. I'm
good
very
Polish
bad.
name.
I would love to hear your thoughts on how the carrier market has been able to sustain below profitability rates for this long. Before I let you jump into this, Ken, I would think one thing I'll say, we are watching carriers go bankrupt at really high levels, and they are continuing to wind down. Many people were just white knuckling at trying to get through the recession on the freight side, and who maybe they paid some debt down. But what are you thinking here, Ken? How are motor carriers able to sustain profitability when rates are this bad?
I think the biggest disservice we do to ourselves as an industry is not understand that when we're talking about rates or we're talking about carrier operating costs, is there's an underlying distribution that sits behind it. There are carriers that are more profitable and there's carriers that are less profitable. Well, if there's carriers that are more and less profitable, there must be different operating costs. And I think it would be unfair to exclude the fact that some carriers are running illegally, they're running unsafely, they are abusing immigration laws if they're following them at all, and so they're able to run cheaper. But there's also, like Dean Croak, our outstanding carrier analyst here at DAT, talks a lot about what about the really great fleet owners that have kind of had their trucks paid off, they've kept up with maintenance, and they're buying. I know a couple of fleet owners personally right now that are buying as people are kind of going under because they're buying down their average fleet age right now. I don't think anyone thinks this market is great, but this fallacy that 80% of all truck drivers are going to go out of business as a result of it, it's just not true. So what's happening is you're seeing a lot of attrition on the right-hand side of that curve. People who maybe didn't have great credit and they have a high truck payment. Maybe they're not super safe or they've had an accident, so their insurance is really high. Maybe they're just not a good business person and they think, they need to be cherry picking high rates and not running more miles. So there's all these reasons why your average cost to operate could be higher. But the fact of the matter is, I don't know, 85% of the distribution is still running at a point that's sustainable right now. That being said, 15% potential attrition through this cycle is really, really bad. I mean, that's a lot.
And Ben, I am sorry. I do know you. I am very disrespectful, and I apologize for that. Now, moving to you, Jason. What do you think on this? Like, how are you viewing this? The same kind of question in front of you.
No, just exactly as Ken described it. Is underlying everything, there's a probability distribution of what costs look like per mile, probability distribution of what revenue looks like per mile. You've got some carriers that, due to the nature of their operations, they have a phenomenal revenue per mile relative to peers. They've got a few key customers they service, their handshake agreements with pricing. It doesn't adjust to the spot market. They're running A to B and back, and that's all they do. That usually gives you a pretty low cost structure, and you're profitable. And so what I'd say is the national average spot rate is not the national average rate that all carriers are receiving for freight. That is very important to understand. Spot is at most 10 to 20% of dry van truckload freight, give or take. And Ken, correct me if I'm wrong, you guys are reporting 250 mile plus, and a lot of freight moves a much shorter distance than that. So it's important to understand that that rate is not the average rate trucking companies are being paid in the United States today. And I think that that is something that we have to understand as well. And the key thing is movements of that rate are incredibly indicative of where the market is going, but the number itself may not be exactly correct. It's the exact same thing we have with the employment data in trucking, where we know the Bureau of Labor Statistics is missing self-employed individuals, but we know that the movement of the payroll data is still very indicative of where capacity is either ebbing or flowing to.
It's also worth noting for the folks that in this industry, there's feast or famine is not new. I mean, this might be more prolonged in some cases, but motor carriers are these days designed to shed capacity when markets turn bad. I mean, there's a reason why someone like Yellow could live for 99 years. So you might cut off clients or move away from things that aren't profitable, but stick with things that are, or just park trucks and wait it out. It's also worth noting there are just decisions people could do. Like if you drive slower, you spend less fuel, you have less maintenance, you have less tire wear and tear. And the other piece, which I always love to talk to Ken about, is you defer maintenance. So as Ken mentioned earlier, I mean, the national out of service rate for commercial vehicles right this minute, it's like 22%, somewhere in that range, meaning that like 1 in 5 vehicles, if you went and looked at it, it wouldn't be safe, wouldn't meet the minimum threshold. So it's interesting as we look at like what people are doing. But this is a question for both of you. I look at this, the S&P is doing great. Like, what are you talking about? What are you talking about, Jason? What are you talking about, Ken? Everything seems fine. Why would I worry if the market is doing so well? My 401k feels robust and strong.
I would say there is nothing more disconnected than stock valuations of tech companies and freight activity, right? I mean, for example, International Paper probably generates more domestic truckload freight alone in the United States than Apple, Meta, Alphabet. I can't even remember all their names now. NVIDIA. I mean, and so that's the reason for the disconnect. Something like Del Monte going bankrupt and winding down winding down unprofitable factories has a tremendous negative impact on the freight market. But Apple stock continuing to cruise towards record levels means nothing.
So we should invest more in Tesla. Is that the fair statement, Ken?
I think broadly speaking, right, it's sometimes the exceptions don't prove the rule. And I think that we lose that sometimes, right? Like when you see a major headline of an auto hauler or something going out of business. I don't know that that's overall indicative of the market writ large.
Well,
I was actually talking with Chris Jolly this morning. I think like there's always a delayed impact, right? So the carriers always get it like right when the market's at the bottom, and then brokers tend to get clobbered over the head as the market recovers, right? Because their buy side starts kind of uncontrollably going up, and then any revenue that they may have locked in, the margins tend to get compressed. So I think it's probably still a little bit more of pain and suffering to come a little bit, unfortunately.
We have a question here. It says, did I just hear that spot freight is only 10% of the market? Can you opine on that, Professor?
Yeah, so estimates vary, but in terms of if you look at the amount of freight that moves on a spot basis, it would probably be somewhere between 10 and 20, give or take. The vast majority of business takes place between shipper and carrier or shipper and broker on a contract rate. And so that's the key thing to remember is that spot freight is the minority. Most freight is accepted on a contractual basis by the primary or secondary carrier, and it never sees the spot market.
Interesting.
Yeah, I think people tend to get a little bit confused because the percentage of brokered freight gets to be conflated sometimes with the percentage of spot freight. And over the years, especially like the last 10 years, brokers have increasingly entrenched themselves in shipper contractual routing guides. So if you look at C.H. Robinson, I don't know if they still do, but they were always very good at publishing their percent contract versus spot on a quarter by quarter basis. And in favorable markets, it would be 55%. In unfavorable markets, it might be 45% contract. So, yeah, I think in total, we're probably hovering right now. Total spot as a percentage of all truckload spend is probably hovering at like 17 to 18% right now. At the height of COVID, when toilet paper was in short supply, it was like 25%, which was the highest it's ever been.
Do you see it going more towards more spot, or do you see the contract will become, this is like the average we should think is what we'll see in perpetuity?
I think like most things, I think the definition of contract is changing. I think flexible contracts, API portals, shipper load boards. Everyone wants to make a load board nowadays. It seems to be like
I've heard.
du jour. Yeah, I've heard there's tons. And they realize how hard it is to actually keep them up and running, apparently. Yeah, so the more that brokers are able to access shippers, I think the share of brokerage, I'm confident, will increase over time. I'm not so confident that like spot is destined to systemically increase over time. But I do think brokers will gain a higher and higher share. What's going to be funny, just to put a pin in that, is at what point do shippers become brokers themselves? Walmart just launched a brokerage. There's Pepsi Logistics is one of the largest brokerages in North America. Armada. There's just a bunch of shipper brokers out there, and things are just becoming very muddied.
I think Amazon, to that point of like shippers becoming brokers, one thing that they know this already clearly, but it's the reason why people got away from private fleets in some circumstances is that ever increasing liability. If you're a broker right now, there's some ambiguity in the circuit split. Like, can you be responsible for the negligence of a motor carrier? But if you're a broker and you pick the wrong motor carrier, it is not unrealistic to think that there could be $100 million verdict sitting right behind you. There's a question here on trucks being unsafe, vehicle maintenance. So I'll bring this up. The question here is pushing back on the 1 in 5 trucks being unsafe. Is it possible that there's some selection bias there, like unsafe looking trucks get inspected more frequently, or these fully random inspections? I'll kind of give my, unless you want to jump off that, Jason.
So there's something called the inspection selection system, the ISS, that underlies this. So that will single out carriers for which the FMCSA does not have enough inspections on file yet to generate a compliance, safety, and accountability score. So it will skew a little bit more towards smaller firms. Those smaller firms tend to be far, far, far less compliant. But and again, if a truck rolls through a weight station and the inspector sees like, hey, it looks like that we've got horrible broken lights. Oh, that tire's falling apart. You're going to get pulled over. But in general, though, I'd say the vast majority does have a huge random element to it. And you can see that by the fact that JB Hunt will have 20-some thousand inspections performed over the last 2 years on their trucks.
Yeah, and to build off of that, for folks that like International Road Trek and the Commercial Vehicle Safety Alliance, they'll do like this blitz, and they'll tell everyone in the industry, hey, just so you know, like we're going to look at a bunch of stuff during this little window. And during that little window, when people know, usually months in advance, the out of service rate when they inspect the vehicle and the things that usually drive you out of service on a vehicle maintenance basis are brakes, lights, and tires, BLTs, delicious to eat, very unhappy if you have vehicles that have those issues. That is traditionally around that 20% out of service on average. So it is not necessarily targeting motor carriers that look unsafe. But to your point, Jason, it's fairly randomized and it's fairly endemic in the industry. Like there is really not a time when we've had an out of service rate that's like 10%. Any thoughts to build off of that, Mr. Adamo?
I think if you really wanted to get specific, you can actually filter in the data what's roadside versus what's called fixed in the data. So that would be like your scale houses, your ports of entry, et cetera, et cetera. I would say that the probability of selection bias on the former could be higher than the latter, but also like, I don't know, if a truck's driving down the road with half of its undercarriage hanging on the ground and it gets pulled over to get inspected and then gets a vehicle out of service, is that selection bias or is that just a cop with eyesight? Like, you know what I mean? Like at a certain point, if we were like arguing on the hairy edge of like between 9 and 10% out of service, I mean, the fact that it's in the 20s, even if it had 5 percentage points of bias in it, like 19 is still unacceptable for anyone who traverses the road system in America, I think.
I like the analogy of like, imagine I'm a grocery store and I have 5 gallons of milk for sale, but one of the gallons is unsafe. And I can't tell you which one. You'd probably say, I prefer just not to buy any milk from you, Mr. Leffler.
Yeah.
But the reality is that's not the choice that we typically get. Now, moving into this next
if you
slide,
were making, before you move on, but if you were going to make a case, Dean makes this case, if you're going to make a case to not rely too much on the vehicle out of service, it's because most of that is trailer driven. If you go into the data, you'll actually see that a lot of the out of service violations that are written on the vehicle side are trailer related. Whereas like driver out of service is just the driver. So I think if you're going to make a counterpoint to like, maybe it's not really 1 in 5 or 1 in 4, it might be that it's you have a truck and a trailer to worry about.
I think in a previous one of these, kind of the three of us talking, Jason, you gave a great point about like driver out of service rates. And like, I think the number was like, if it's 1% and above, like you should even work with them. Am I characterizing that correctly?
Yeah, so that number is specifically the CSA basic score that carriers are reporting. It basically is reporting weighted violations per weighted inspections, where the weights are time-based as well as severity-based. Certainly, if there's a carrier with a CSA basic HOS above 2, you should not touch them. And I'm not talking the percentile score. The percentile scores are meaningless. They're not what you think they mean. Don't use them. I won't go into why, but just don't do it. Just look at that absolute score. If it's above 2, run away from that carrier as fast as you can.
Super Trucker over on X has 1 in 4 trucks are just the ones that get pulled for inspection. Insane. Yes, I would say this. If you're looking at vehicle maintenance, like I think Hope Trans is a good example. This is a motor carrier, decent size, involved in a horrifying truck crash, killed a family of 5. Their out of service was 34% of vehicles inspected failed. So we, as an industry, know this is a problem. Like we know this is an issue. It means you have to spend a lot more to fix it, but it's a little bit different. There's a question here from Adam over on X saying he's heard that recent ELP out of service, so English language proficiency, is being listed as vehicle instead of driver. I've not heard that. I would think that'd be incorrect characterization, because for those again who followed the English language proficiency, this has been the law since the 1930s. It's been enforced differently, but it's been the law for a long time. So it's not atypical for this to be enforced, I think, in a general way. So you guys heard anything on that one way or the other?
It's all hand. I mean, it's going to be hand entered roadside or at a scale house. So I wouldn't be. It's 391 is the kind of hierarchy, which rolls up under general driver classification. So it should be enforced as a driver out of. I love, first of all, that people have gotten so enamored with the DOT data dissemination program. It warms my heart to see everyone being, and I mean this in the most endearing way possible, armchair analysts. But yeah, if the probability of it being misclassified is pretty high, I would say.
I'd also kind of, for folks on the ELP side, as we think about this, we didn't see a constant like increase in enforcement resources. And so if you're in the world of like regulation and enforcement of regulation and different outcomes, you might change how you prioritize things, and that's fine. But unless you're willing to put a lot more resources into the actual enforcement of things, whether it's a state level or federal level, whatever, you're not going to likely see major changes in outcomes. It's more like a function of there's only so many hours in a day that this guy or gal's going to work. And once the day is over, like they're not going to do more. It's interesting. So this graph here, I'm going to start talking about why I feel like I'm a frog in a pot. And I don't know if the water is just warm or if I'm just sensitive to temperature. This just shows that the U.S. home buyers and sellers. So there's more sellers than buyers. And it looks like, based on this little chart here, which people listening have no idea what I'm talking about, there's about a million more or so, hundreds of thousands more sellers than buyers. So people want to sell houses for any number of reasons, but if you don't have a buyer, it means your property is likely not to sell. And we're going to get to why this might be interesting, but any initial thoughts of like people trying to sell and not having a lot of buyers? Is it interest rates? Is it just something unrelated?
Yeah, it's 30-year mortgage rates are still well above 6% right now. Home prices are at record levels. They're up 50% from before COVID. So for those of us who are locked in on 30-year mortgages that are sub threes, moving right now is an incredibly unattractive financial opportunity unless you're going to see a massive raise. Combined with the fact that the hiring rate is at the lowest level it's been in more than a decade, and that's typically the thing that causes people to be moving a lot, is you're getting jobs around the country. And so you combine the fact that it's unattractive to move, typically right now from a financial standpoint, and the fact that companies aren't hiring as much, you get a situation where people are not buying as many homes, but more and more and more people are wanting to get out, either cash out or, they don't want to live in that area. So Florida is starting to see a little bit of that dynamic right now.
All right, well, let's move on to some more depressing things. This here, since we're back to school, I mean, this is a great time. Everyone's excited. I am an adjunct law professor, so not a real professor, but kind of a real professor. I only teach in the spring, not teaching in the fall. But our good friend here, Professor Miller, is a real life professor, the real deal. We're seeing student loan defaults go up. What should we think about that? I thought they were all forgiven. Like, I stopped paying them. Are we supposed to keep paying them?
Yeah, no. So we've seen basically student loan, essentially the percent of student loan balances that are 90% or 90 days plus delinquent. That has skyrocketed the last 2 quarters to basically being right back to where it was before COVID. So a lot of student loans had been in forbearance because of the pandemic, and that's ended. Big reason why this matters from a freight standpoint is this is just another headwind on freight demand as we think about consumer goods right now, because you've got folks who are now needing to pay those student loans, and many of them haven't been. They're not in a financial position to do it. And so that's just one more headwind in terms of the extra spare money people have to be able to buy goods that are the big driver or one of the drivers of transportation demand.
Now, Ken, as we think about like, what does a freight recovery look like? Because we talked about this a couple months ago when the three of us were together. It was either you have more demand from consumers or you have less capacity to move it. Do you see anything that like would indicate there's going to be more ability to buy stuff? Or is it still maybe we just got to get rid of more capacity and that'll end up making things cost more and drive rates up?
I think we've said it all along. Everyone will be very disappointed if this recovery cycle is purely driven on supply contraction. So I do think supply will exit the market and put more upward pressure on rates, but I don't know that much off of equilibrium. But yeah, I think people need to buy stuff. Interest rates need to come down. I think that will be a general lid coming off of many different things that support the freight economy.
So fire Powell.
I don't know about that.
Sorry.
But yeah, whoever appointed Powell should be really considered for their hiring decisions.
That's a good point you bring up.
But yeah, I think we need to see a return of demand. I don't know if I were a capital intensive business magnate in America, which I am assertedly not. But if I was, I'm not putting any steel in the ground right now. Would anyone put steel on the ground right now, given all of the economic, and that steel could be 70% more expensive tomorrow than it was today? And I know everyone likes to pound their fist on the table and say, well, just build American. And contrary to popular belief, you can't snap your fingers and reignite the American steel production overnight.
It kind of drives to this next little graph here. Again, this is courtesy of my good friend, Professor Miller, with delinquencies in credit cards and automobile loans. And I think one of the things we look at when we say, okay, where is the possibility for demand to come back? What are the things that you don't miss? You don't want to miss your car payment because you might lose your car. Usually you don't want to miss your credit card payment, but we all Americans, we have that same problem. We get in more than we can handle. And if you see these different things saying the American consumer is struggling to pay bills, there really isn't a clear path of where you're going to find that demand. What were you, when you sent these to me, Jason, like, what does this kind of tell you? Or how are we feeling right now?
Yeah, so I think the big thing is it means the consumer is strained. Now, the good news on both credit card and auto loan delinquencies is they didn't move upwards even more. So it's kind of like, okay, we may be reaching a peak on the credit card side for folks not looking. It's well above where we were in 2019, but it's a little bit below where we were in 2010. Now, that's in the aftermath of the global financial crisis, so that's not reassuring. On the auto loan side, it's kind of a twin peak of delinquency around 2010. Believe it or not, 2019, we were having a lot of people delinquent on their auto loans right before the COVID pandemic. And then today. And so the key things that I see is there's no chance that there's going to be a resurgence of consumer demand that's going to be a big driver of freight volumes. If anything, when we look at the import data, that's suggesting almost the opposite. And so that then gets us to start thinking, well, what could be those demand drivers? Most of us this year, certainly I was forecasting it, was single family housing. Because last year we had 100 basis points of interest rate cuts. The expectation was we were going to have some more cuts this year. And because the whole ecosystem around inflation we thought would look better, that would cause the 10-year treasury to start to come down, because that's what the 30-year mortgage is tied to. So that's the one thing everybody needs to understand. The Fed can cut interest rates 25 or 50 basis points, and the 10-year may not move. And if the 10-year doesn't move, that means your 30-year mortgage rate doesn't move. And so for me, as I look at it, what can drive freight is housing market really kicks off, commodity markets really kick off. Those are the big two sort of exogenous shocks that can stimulate demand. And right now, they both are not doing well. And we are kind of where we are.
We had a comment here from Ben. Said in 2017 was the only time that he thinks he saw an increase in rates related to the shrinking of the carrier market, though it was short-lived. Do you have any memories of those days, Ken? Like, do we think there's a possibility that we could destroy enough carrier capacity to unlock something that's productive, or are we really looking at like this has got to be growth of the overall economy?
I think that was different, right? You were on the foothills of ELDs, which was a systemic shrinking of carrier capacity. You had the Trump first-term tax cuts coming into play. You had a very busy tropical weather season. Wasn't 17 Irma, Harvey, and
yep,
one of the other ones.
And a commodity market boom. We went crazy fracking again in 2017. Oil started to really come up. So you had a perfect recipe.
Yeah. So I think, that's a hard benchmark. That's a hard benchmark to compare against. I think like my on record anticipation for this cycle was like a 13 to 17-esque cycle. And I think like, I don't know, if and buts were candy and nuts, we'd all have a Merry Christmas, to quote Don Meredith. But like, I think right after the election, as we rounded a very strong peak last year, we were poised for that kind of recovery. And then I won't use Gordon McGill's flowery language on your astute podcast, Professor Leffler, but we did something in the bed. We crapped the bed, and we are where we are right now. And no amount of taking non-English speakers off the road is going to help that, unfortunately.
Yeah, I think Ben builds off this says like the 10-year won't move until we rein in our deficit. Do we worry about deficits anymore? Do we worry about national debt? Like, is that a thing that we should even think about, or is it something that we should be aware of?
We worry about deficit spending when interest rates are high on that debt. So probably the most informative series is taking federal interest payments on the debt relative to GDP. That series is not pretty right now. We're basically back to the highs from the late 1970s, early 1980s. And so that's why it's a concern. When the government could borrow at 1.5% for 30 years, go for it. Run up as many trillions of dollars of debt that you want, because I guarantee you we can find an investment that yields a 1.5% return. Like, that's very easy, but it's when we're having to borrow at 5%. That's when it's a problem.
And as Super Trucker alluded to, he says capacity comes into the market a lot faster than it exits. So this is the question I have for you, Ken. You put out charts like entering carrier capacity, entering the business, carrier capacity leaving. Do we still see people coming in and going like, this is the American dream. I'm going to be a business owner. I'm going to have my own truck. I'm going to make a bunch of money. And then they get surprised. Like, how fast are we seeing motor carriers leave? How fast we see them join?
I mean, industry turnover is still about 100%. So, again, I think that's one of the low key, things you got to be ready if you want to get into the load board business, is you need to re-recruit your carrier base every single year, right? Because actuarially speaking, they're turning over at 100%. But yeah, I mean, we're still 8,000 to 10,000, maybe a little bit more carriers over the pre-COVID trend. Now, carrier counts is not a great one-to-one proxy for rolling capacity down the road, so fully caveat that. But I think it's a good, if you kind of track it constantly over time. But yeah, if you look just last month, right, we had 4,500 new entrances, 2,000 re-entrances, and 7,200 departures.
Yep. It just happens.
Are the barriers to enter this business too low to get authority, to get a truck, to get a CDL, to get insurance? Is it just too easy, or is it just the amount of easy you think we ought to want to have?
Go ahead, Jason.
No, I mean, so the caveats I'm going to put to this: new entrants are incredibly unsafe relative to older players, all things equal. Now, that is not a trucking unique thing. That is a literally every industry and that has ever existed unique thing, that new entrants tend to be less safe. The converse of that is if you have tighter barriers to entry. I mean, we experimented with that from 1935 to 1978 on a really, really, really hardcore basis. And it was a phenomenal era to be a truck driver. And it absolutely was horrible to be a shipper. And so part of that is, as a society, we have decided basically that the consumer, all 342 million of us that consume goods, benefit from cheap truck transportation relative to the 1.8, 1.9 million people that work in the industry. So we've basically, as a society, have said, hey, we're willing to tolerate a lot of new entry and a lot of unsafety in return for a lower cost.
If you're following along, I'm no adjunct economics professor, but that is a negative externality that we're willing to accept as a result of having cheaper goods in the store.
Yep.
It's a great kind of to plant a flag on this a little bit further, to give people the kind of the scope of what that was like. So my father's a roadway guy back in the 70s. So he was in the world of the unionized motor carriers, heavily regulated industry. In 1980, and this is round numbers, there was about 18,000 motor carriers. Today, there's about 550,000. There was a handful of brokers in 1980. Today, there's 25,000 of them. The average truck driver was unionized. About 70 to 80% were Teamsters. They were all unionized for the most part. And they were making about 37 to 38 grand a year. When you adjust that for inflation, it's like 110, 120. It's a different world. You look at it today and you say, okay, what is the job now? What is the job now? It's, to your point earlier, Ken, 100% turnover rate at the big carriers, and for people starting their businesses and trying to make a go of it. And the insurance rate, the insurance liability you had to have to be an interstate motor carrier is essentially it's not changed at all. It was about 750,000. It remains 750,000. And you gotta say, is this the best thing? Because to your point, as Jason mentioned, it means things are cheap. It means things were cheap. We made it cheaper by making the drivers less compensated, less potentially trained. We removed the regulation. I don't know. Is this good? Should we be satisfied with it?
It's one that let's put it this way, we will not solve it on this. That's impossible. It's one that societally it is the reality of trade-offs. I mean, and this is the same issue that touches on the tariffs and offshoring. If you look, it's easy to project and say, if we still made the same amount of apparel in the US that we did in the 1990s, essentially still the same share, our cost of clothing would be double what it is today. What do we want? Do we want cheaper clothing, or do we want, more expensive clothing, but maybe a few more manufacturing jobs that are not automated? We as a society have said 342 million of us need to wear clothes, but only 900,000 of us in 1990 worked in apparel manufacturing, and by extension to textiles, call it 1.4 million. 1.4 million, 342 million. And so if you look at the last 40 or 50 years of regulation in this country, it has been very skewed in general towards empowering the consumer. Some of that comes with bad things, predatory lending and things like that. But that's where we've really kind of shifted as a society since, I'd say, the 1970s.
Well, I want to pivot now as we look at, because I think you're right. I think we can't solve that problem. I would like to, just for the record, I'd like to see the liability insurance increase and the enforcement resources increase. Just for my purposes, I'd like to see that.
Oh, give me more enforcement resources. That's a new study for me. So yes, triple the amount of enforcement on the road. Please do that.
That would be, that we could all get behind.
I think this is the frustration from the mainstream though, right? Which is, it's very hard to find a vocal advocate for things like English language proficiency and foreign work visas that would also support tripling enforcement personnel and raising the insurance requirements.
You got to make a new party then. Maybe the truckers.
No, I mean, in all reality, right? Like, so the barrier of entry needs to increase. I would agree that it needs to increase for everybody. And I also think, like, be very careful what you wish for in terms of like going back to a regulated state, because that would wipe out, by any estimate, 80 to 90% of owner operators and small fleets would be gone.
Absolutely.
Yep.
The ATA would love nothing, I suppose. I don't want to speak on their behalf, but I just have to assume the ATA would love absolutely nothing more than re-regulation of the trucking industry.
My feeling is, like, I think that they do support the small, mid-sized carriers. They generally, from my perspective, do not like regulation generally. And like it might be beneficial to different motor carrier sizes, but they just don't like to see any regulation increases. But I think, like, one of the things I'd love to see the FMCSA do at some level is, if brokers can sometimes be held liable for the negligence of a motor carrier, brokers should legally be required to carry that insurance. I hope SCOTUS takes the case up and looks at this issue, because it is very complicated. But if there are jurisdictions where they can be held responsible, then it creates that free rider problem we talked about before, where you could be liable, but you've chosen not to carry liability insurance. And so therefore you've put that expense onto the broader people. What I want to pivot to is more big stuff. Forget about the people in the trenches. Let's talk about big M&A. I am thinking, and I'm seeing lots of interesting activity in the space. Before I jump to you, Ken, because you clearly know this better than I do. Jason, do you see this as an opportunity for companies to start doing deals because of the nature of this business? Or is it wait until 26 because it'll be better then, I'll have a better value then, I got to hold on until then? What have you thought about that?
Not really. I think it really comes down to what opportunity presents itself. I think the one biggest challenge with M&A in this industry is a failure to appreciate the complexities of melding together different freight networks that may not be complementary. I'm going to pick out a name, and I'm not picking on this company intentionally, but Heartland Express used to be one of the most profitable truckload carriers out there, and now they are just basically lighting money on fire each quarter with negative operating ratios. And most of that is because of a couple acquisitions that did not work out well. And so you have to be very, very, very strategic. If the opportunity comes along to identify a carrier that has, let's say, good customer relations, that freight fits well within your network, it's complementary to your existing lanes, then by all means, go for that acquisition. On the other hand, if it's something that doesn't mesh well, then you probably want to avoid it, because nobody wants to be Heartland Express right now at the moment.
I completely agree with you. I used to work with Heartland. They had some incredible equipment. Worked with Gordon Trucking, one of the companies they acquired. Great businesses, loved their equipment. They had incredible maintenance practices. And to your point, you see these operating ratios come out and you're losing money. It's like, oh man, I hate to see that. But if you strap yourself up with a bunch of debt and you go out there on a buying spree, it becomes difficult unless you can pay cash. So Ken, like you've been I've heard rumors DAT has bought some companies lately. Can you opine about what you're seeing in the M&A world and your vantage point?
Yeah, I mean, on our side, our scope of investment is rather particular, right? It's areas where our unique position and scale and distribution can offer something that very few, if any, other companies could. And you've seen that along the way with Trucker Tools bringing visibility products primarily to brokers and some shippers. You've seen Outgo kind of lending primary distribution to carriers, and now Convoy directly to brokers. Right, the two things that have harmed the scale of digital freight matching historically have been neutrality. They've always been attached to an actual broker, and scale. So, day one, we bring another 170 some thousand carriers into the Convoy network. And then, we're fully neutral. We have depending on what you might read on some like sad, angsty LinkedIn poetry, we have no intention of becoming a broker. So we are fully neutral, so this will be the first time this experiment's ever happened with a fully neutral network. I think
it's also like interesting because there's been so many technology companies that raised money in the height of the pandemic with all this investment capital, throw, and people have been burning money to the point earlier. Do we think we're going to see the technology companies start getting rolled up, or go bankrupt? What do you think was happen there?
I think we're probably about halfway through it, right? We've seen quite a few. Descartes been in buying mode. I think you'll see that persist through the fall. I think the halcyon idea that you're going to at least be able to backstop your valuation of what you raised during COVID and get out at break even is probably fading with the waning days of summer. So I think there's going to be a lot of folks. It's going to be a busy banking half is how I would describe it. I think underwriting a freight tech company during the height of the craziest freight boom since World War II is probably going to come home to roost for some of these venture capital and private equity firms.
We got another question here from Super Trucker. It's not really a question, more a bunch of emojis for clapping and the word TWIC cards for everyone. There's this idea of finding ways for making more types of regulations around driver, who they are and different entities. Have you heard about this idea of TWIC cards for everyone?
I can't say I have.
What about you?
I think it's a good idea. I mean, I think
what is it? You need to have. Tell me what it is. I want to.
What is it? Trusted worker. Trusted worker. What does it stand for?
You can always jump in.
It's basically like a TSA. When I was in the industry,
exactly. That's my understanding.
You had to know if you had a TWIC card to go pick up something at an airport or another kind of port, or if you need to. So like your highest qualified drivers would have like their hazmat cert, their TWIC card. I don't know if you need TWIC and TSA certification to go onto an airport now, or if you could just get by with TWIC. But look, I went into a Home Depot the other day, and you can rent equipment with Clear, the same Clear you use at the airport.
Yes, I love Clear. I use that for validating my LinkedIn. My wife does not like having my biometric information scanned.
Again, I don't want to keep beating a dead horse, but you've got a guy whose primary qualification was being on reality and television and Fox News, and they're talking about building nuclear reactors on the moon, and we want to like roll out a massive technical infrastructure problem to bring 4 million drivers to require a TWIC card. I think it's a great idea, but we have to actually talk about how these things are going to be implemented and scaled. I don't know how you place priority between the nuclear reactors on the moon and making sure American trucks are safe. Like I would think that the latter is a higher priority, but I'm not sure.
All right, as we kind of get to the back half of this conversation, I want to look at the future of the back half of this year. What should we be looking for to say whether it's a good sign or a bad sign? Like, what are the things that would be either concerning or something you should get excited about in the next few months? I'll start with you, Jason. Like, what should we be thinking about or looking for in the upcoming weeks and months?
So August data, looking very closely at the manufacturing new orders from both the Federal Reserve banks, the 5 Fed banks that publicly report that, as well as ISM, S&P Global as well. we're wanting to see new orders get back into expansion. If they stay in contraction, you can completely write this year off historical basis. The other thing we need to start watching for is parts of the consumer price index as well as the producer price indices where we would expect tariff-driven inflation to start to show up more, because that's going to help us forecast what the Fed's likely to do. So we, for example, in a lot of different parts of machinery and electrical equipment, we're seeing right now 8-10% year over year increases in prices that domestic producers are charging their customers. That is the type of cost push inflation that causes the Fed to hit the pause button and say, hey, even if the job market's weak, we're not lowering interest rates. And then, of course, take a look at where jobs numbers are coming out, because over the last multiple recessionary cycles, jobs have been the biggest factor that really indicates whether we are or are not in a recession.
Do we think a recession hits, or is that have we avoided that? Is that something we should be thinking about?
I think it's the realest possibility it's been in a very long time. I saw Mark Zandi the other day post on LinkedIn. He's the chief economist, I believe, for Moody's, that over 50% of industries are actually seeing declining jobs right now. And that is historically a fairly prominent indicator that a recession could be incoming.
I always look at copper as this really interesting material because there's so much electrical stuff, home building, everything's tied to copper. And I saw a post from, I think, Scott Cornell from Travelers talking about seeing increases in cargo theft related to copper because people kind of realize, oh, this thing is more valuable than it was yesterday. Are there any commodities or things you would suggest someone follows, like any worthwhile things to kind of understand what the future might hold?
I think commodities, it tends to be very difficult to read into them because those are global industries. As an example, we've seen lithium prices the day we're filming this go through the roof because Cattle, the largest producer in the world, shut the largest mine down in China for the next few months. Believe it's part of an effort by the Chinese government to get some of the overproduction under control. But so lithium prices skyrocketing doesn't really tell us much about, recession or not. It's this one-off thing. So I think commodities are much harder to follow versus, I'm going to say, the more like the government data that really, makes us, really connects to us. I will tell folks, get prepared. When they announce the preliminary annual revision for the jobs numbers, everything suggests it's going to be negative. So get ready to hear all.
Someone will lose their job over that. Clearly, that can't be realistic.
Yeah, well, and it's going to especially be bad in manufacturing. So I'm expecting manufacturing payrolls will get revised down at least 100,000.
Good gracious! All right, well, let me pivot to someone hopefully more positive. Ken, what should we be looking for if you're a broker, you're a motor carrier, or even maybe a shipper? I mean, shippers have got to be excited right now, I would imagine.
Their core businesses aren't doing great. We all have to remember that shippers don't think of themselves as shippers. They think of themselves as like cereal producers or whatever. And in a lot of the sectors, unless you're like powering the AI revolution, your business probably isn't doing super great right now. I don't know. I'm usually the eternal optimist. I think back to school has been very, very disappointing. There's this phrase that just keeps rattling around in my head, which is like, you don't pay more for things you don't buy. So I think like some of the inflation statistics are hiding some of the underlying cracks and fissures in the economy. I don't know. I guess this is less expecting. I guess I'm hoping for a somewhat decent peak. And then as we get into next year, as interest rates come down, a bit more tailwind into our industry.
When will we start getting some idea of what peak will look like? Is it looking at imports from
post Labor Day?
China?
Yeah.
Okay.
Post Labor Day, we'll start to really watch it closely. Like I said, last year was a really good peak. And if you remember, the return rush and some of the weather held on for several weeks past the holiday into the middle of January. And then, like I said, everything just sort of collapsed.
Well, as we get close to the end of this, I'll have you guys each answer this question. I'll start with you, Ken, and maybe you can kind of go off on any tangent you want. But you know me, father of four, lawyer, adjunct professor, not the real deal. Should I panic yet? Should I panic?
Only the paranoid survive, right? So I don't. I think panic is a very bad business strategy. So I would not advise panicking. There's another P word. I think you can plan. You can prognosticate. You can do a lot of different P words.
I like alliteration.
I think it's just time to hunker down. And the businesses that come through this, the businesses that stay strong through it are the ones that are built to succeed, both ups and downs. They weren't panicking when COVID hit and everything was good, crazy. They're not, dying when things are bad, crazy. So I don't advise panicking generally, but this maybe February of 2019 is as bad as I've ever seen. I wasn't in the industry for the great financial crisis. I was trying to find a job out of college. I was panicking for a different reason. But since I'd say like February of 19 was as bad.
You mean February of 09, right?
No, 19.
Okay. 19.
Well, no, I guess that would have been 20. I'm sorry. That would have been 20. So the year would have changed. I left the industry in December of 19.
Okay.
And if you remember, February, March of that year is when they planned the May Day protests. It's when Trump said he heard the horns out front. So yeah, that first quarter pre-COVID in 2020 is as bad as I've ever seen it. And this is rivaling that.
Well, that is I like that generally you don't advise panicking. I think in this case specifically, you also don't advise panicking. I can respect that. But Professor Miller, I need to know, we've been colleagues now for a year-ish in some form or fashion, friends for longer than that. Should I panic?
No, I don't think panicking is ever beneficial. I think, as Ken mentioned, you plan. I think the biggest thing right now that I'm seeing that's going to catch a lot of businesses is I've never seen an environment where people's political beliefs are shaping how they perceive economic data that is arriving in. And that is very important because the interpretation we put on data, it's always going to be ours. Data doesn't speak for itself. We have to interpret it. But there's certain points you have to accept a reality. And so, for example, folks saying, well, I'm still hearing some people say, well, ELP just hasn't had time to kick in yet. No, this was a shock that should have taken place immediately. Nothing meaningful has happened. It's over. It doesn't matter. It is a drop in the bucket in terms of the overall rate environment. Time to move on. And so I think that people need to do the best they can to, really sort of, try to accept what the data is saying and recognize that, we are in unprecedented times. There is no basis for this tariff shock that we've been, experienced. But just to give a sense for how the magnitude of the number of firms being affected, the population level data indicates that back in 2022, the most recent data we have for this, over 300,000 firms in the United States were importing goods, and they were employing roughly 67 million people. So that's like, I don't know, 1 out of every 2.5 folks who has a job. And so we right now have 300,000 firms going through the biggest cost shock that they have experienced in a very long time, to where many of them aren't sure they can pass on those costs right now to their buyers. That is going to take a long time to filter its way through. So be prepared for a choppy 6 to 9 months.
It's interesting because we went from being a producing, manufacturing, agricultural based kind of community or nation to a service-based industry, service-based nation, and everything requires something else. And even if you're a domestic manufacturer, you use things from somewhere else to get it done. So it is incredible to see how this changes. It's also fascinating to me because for many years, both the Democrats and the Republicans were of the opinion, low tariffs because free trade is beneficial to everybody. And we're doing an experiment. And it is challenging not just the economics of our country, but also the legal framework. Like these cases that are happening, they're percolating. They're very big cases with really important major questions. As we get to the very end here, are there any final words you can leave us with as we get ready for back to school, Ken?
I now understand why my parents were so excited when it was time to go back to school when I was little. I have 4 boys under the age of 10. And we're going on vacation next week. And when we return, they will, thankfully, 3 of the 4 go back to some form of other people's control 5 days a week.
I love that. How about you, Professor Miller? How is any final words for back to school?
Nah, other than let's put it this way. Just realize the type of strain that those teachers go through, managing your kids for 7 hours a day and having 15 to 20 of them in a classroom, and just think what that feels like. So just be understanding. I think the general public who has never taught a class has no concept of how difficult that is. Matt and I were joking before this when he got around to teach. I told him, I'm like, hey, don't underestimate how many hours of prep it's going to take per class. And you even said, you're just making some number up. And you're like, oh man, that's a real number.
Yeah. The number you quoted me was for every hour you teach, you have to have 3 hours of prep. And I said, that's impossible. That's impossible. You were right. Actually, it took me more because it was my first time, but it was brutal.
Yeah. So think about what those folks are doing. They're teaching for 6 or 7 hours a day, and then they're having to prep, and then they're having to grade. So if you think teaching's an easy job, put it this way, just give everybody some grace.
I think grace is a great way to end. There are a lot more questions and comments in the notes here. We'll try. I'll try to convince Jason and Ken to jump in, maybe if they have spare time this afternoon, to answer some more of your questions. But I gotta say goodbye to Jason. Goodbye to Ken. Everybody, this is what I love to do, to have the incredible folks like Professor Jason Miller of the Eli Broad College of Business at Michigan State University, go green, and Ken Adamo, Chief of Analytics at DAT, Dial-A-Truck, coming on and answering your questions and mine as well. Really, this is about me, but I'm glad you could sit in on it. The advice I think we leave with is do not panic, do not despair. These times, unprecedented though they are, will always pass, as all things do. And it's how you handle yourself in these moments of uncertainty that test your mettle and prepare you for whatever happens next. I hope it's something positive. I really do. I'm praying for it. But before we say our goodbyes, I have to say thank you to my friends over at DAT, Dial-A-Truck, making some big moves. In less than 10 months, that company has transformed itself with acquisitions of Convoy, Outgo, Trucker Tools. The real Fantastic Four, if there ever was one, who's going to be Dr. Doom? That's a good question we'll come to in a later show. And of course, our friends at Genlogs, cameras all across the country, setting a new standard of care for freight intelligence and figuring out, where's my stuff? Maybe the camera knows. Maybe Ryan Joyce knows. Maybe we all need to know a little bit more. Until next time, we'll see you at the Armchair Attorney Podcast. My friends are still in the back room. I'm going to say hi to them. So you guys got to get out of here. Go. End the show.